The market flip-flop continues. I'm here with Tony Drake, CEO of Drake & Associates, to break down what it all means for your retirement. Tony, bond yields have increasingly become a focus point on Wall Street. If I plan on retiring, because obviously I'm of retirement age, retiring this year, should the 10-year have me on edge?
You know, it's certainly catching a lot of media attention, and particularly for retirees, if you're retired or nearing retirement, you know, hearing all this noise can be really scary. But I think it's important to look at the fundamentals of the economy. You know, we would look at our U.S. economy, job starts are great, unemployment's low, and one of the big indicators we look at is consumer spending. I mean, the June rate was over 8%. You know, economy is doing good. You know, when we have these European, the ECB just announced they're going to buy about every debt instrument they can, and, you know, it may be more of a supply and demand issue. So it's really important for retirees not to get too focused on one big media headline and really focus on the big picture, have a plan, and try to stay calm and stay focused.
So after such a volatile week, how should investors approach their 401k or their portfolio?
The biggest thing is to have a plan. If you have a long-term plan, you don't want to make short-term reactions to what I call kind of situational events that happen, right? If we look at this inverted yield curve that's getting all the attention, data shows us it has to be 10 days plus before it really has a good indication. And again, there's a lot of economists that are saying may not be the indicator that it used to be. Not to mention the 6 months and year following a yield curve inversion can be really strong. So best thing is to have a plan, make sure you're staying diversified, rebalance the portfolio, not due to a yield curve inversion, but due to the right balance that fits with your plan and your time horizon.